So we're going to move into the last bit of the chapter, but before I do, I'd like to just remind you where we've been. We talked a lot about operating cycles versus accounting cycles. We talked about perpetual and periodic inventory stuff and why perpetual is probably from an accounting standpoint a little bit better. We talked about buying stuff. We talked about selling stuff. Buying stuff is all masked in that inventory. Selling stuff has, it felt like double the journal entries. Would you agree? Because we had to talk about selling the stuff and then how that impacted inventory. But then we also talked about the extra accounts, this one, and COGS as what are called contra revenue accounts that offset money made. So instead of throwing it all into inventory, we break it down account by account. Today I'm going to talk about just the vocabulary that goes with both adjusting and closing entries relating to merchandising businesses. You will not have to do any of those on the test, but you could see one or two questions about it. That's why I still want to address it. Today I'm also going to lecture on this section as we build a multi-step income statement. Tomorrow we'll actually do that and get ready for end of chapter stuff. Again, this section that I'm going to talk about, you will not see problems, but just understanding vocabulary. Adjusting and closing entries are toward the end of an accounting period. Adjusting entries, remember we adjust for what we used or what happens. They're really about the same. A service company versus a merchandising company. We will see one additional adjustment just so our inventory actually agrees with what's there versus what's on paper. And when you do an adjusting entry, the two accounts impacted here. Again, we're not going to have to do it. It's just that you need to know when we add in merchandising and we have stuff sitting around, we do have to adjust for the stuff that's gone. Kind of like supplies. What we start with, what we end with, well, the difference is what we used. What we start with inventory, what we end with, the difference is what we used. And so here is an example of an adjusting entry. Suppose this audio supply has an unadjusted balance of $40,500 in merchandise inventory. Through a physical count, someone counted and found out that we ended with 40. Does that mean we didn't sell any at all? We only sold $500 worth? No, we probably bought more and sold, bought, sold. But what we started with minus what we ended with is what we used. So what can you tell we used here that we need to adjust? The $500. Maybe you've had to do this if you work in a retail setting. I know I've been in, say, Target, when you can tell Target brings in their inventory counters and there's like little tickets all over the place. Do you know what I'm talking about? You've either been at Target when that happens or it doesn't. You can tell that there's people like, well, Target's of course a big box store, but they're counting. They're counting. Well, how many sweatshirts are left? How many, Barbies are left? They're counting. How many after a physical count? And when Target comes in, they have all the scanners. They're buzzing all the barcodes. They're putting stickers on things just to count to get ready for year end. So you'd see cost of goods sold go up because that's a debit-based account because it's a contra revenue. And inventory go down, meaning that inventory is gone, and as a result, the cost of goods sold went up. This is the adjusting entry. Again, you're not going to have to do an adjusting entry for the test, but you should know that it gets added to the list of adjusting entries. Same thing with closing entries. We have to close this money made. If you remember, there's 4 closing entries. We close revenue, we close all of the expenses, we close income summary, and then we close drawing. So Process is the same. It's just that we're going to add things like this, this, and this. We've got freight out. Otherwise, you could probably wade through the rest of the expenses, no problem. Now, although you don't see the word expense on the 4 that I emphasized, they're kind of like expenses cousin. They kind of act like an expense because they offset how much money we made. Again, those 4 up there, 3 plus the freight out, are kind of like an expense or a contra revenue account. So if I were making you do adjusting and closing entries, we'd have to close all these expenses just like we had to during that chapter, but then we've got these new ones that get added in. That's all I wanted to talk about. I just wanted you to see it. Because then as we take revenue minus all of these, you hope we've got a net income to still dump into capital. We're probably making more money because we have more stuff to sell, but that stuff isn't free. People are returning. Again, that cost of goods sold is in there. So it's still the same concept. It's just that there's just more players here. That's why the operating cycle takes longer, because there's just more stuff to manage. So that's all I wanted to talk about in that section. Just know the vocabulary. For this last part, we are going to look at, okay, we've journalized all of this. We've adjusted. We've closed. What does the end product look like? Or in other words, the financial statements. Okay. Although the chapter talks about a classified balance sheet, I'm not going to test you on that. You were tested on that last chapter. You'll be tested on it again when you have the midterm in a couple of weeks. Okay, so although the chapter talks about it, we're not going to cover it. If you think back to last chapter when we talked about what's a balance sheet versus a classified, same thing here. What's a single step income statement versus a multi-step? And before we get into it, let's just talk about income statements in general. Remember, an income statement in general is revenue minus expenses to yield either a net income or loss. That's a single step. You took a look at your revenue. Sometimes there were multiple ones there. Then you take a look at your expenses with lots listed there, which hopefully brought in a net income. That was a single step income statement. A multi-step, you have to stop and say, well, what was cost of goods sold? Then way more steps. And so what I'd like to do for the remainder of this lecture is talk about all those steps. Here's what it looks like. A lot of steps, a lot of stopping points. Do you have this full one in there? Perfect. We're going to draw we're going to chop this thing up a little bit. You first take a look at your sales revenue. Minus these 2 contra revenue accounts equal what's called net sales. Let's chop that top part up first. Then we can say, well, what was the cost of goods sold to finally equal that gross profit? Now, the reason this maybe sounds familiar is because this is what we started with. And I'm going to bring you back to that slide here in just a moment. But that top portion is taking a look at sales minus, like if they returned stuff or if they paid within their discount period to equal what's called net sales, subtract off the fact that nothing was free, cost of goods sold or COGS, to finally equal gross profit. Then we can draw a line. Oh, sorry. Oh yeah, I was in the right spot. Nope. There we go. So this all has to do with revenue out here. These have to do with expenses. Notice we haven't called it net income just yet because there's income and expenses from other areas, which I'm going to get into in a minute. So I'm going to call this other revenue and expenses. Okay. So we take a look at revenue minus expenses, then we have other money in and other money out to finally equal what's called net income. Since I had this all on one big screen, I wanted to show it to you first and break it down. Next, I want to keep going with our list. So once we've determined net sales, taking a look at revenue minus these contras, then we're going to say, okay, that equals gross profit. Then we can take a look at, well, what were all of our expenses? And I think this list is on your sheet, right? Non-operating activities. So this bottom part is this other. I'm going to give you a kind of a loose example. Yesterday I got an email in my Junk by Jenny box saying, it's the newspaper, and they're like, would you like to sponsor an ad coming up here for this Christmas edition that we put in the newspaper? Sure. Was that an expense for me? It was. Was that an operating expense, though? It was an other expense because I normally don't do that, but I thought, sure, it had nothing to do with, I wasn't advertising a sale, okay? I wasn't paying my website fee. It was a form of advertising, but yet not directly tied to my operation of my business. Rather, it's just more of like a non-operating activity. I think they go, yes, okay, perfect. Do you have this in your notes, I hope? No? Is it on your next page? No? Okay, this is a really, really good one. So what are some examples of other revenue and other expenses? Remember, the other bottom section has nothing to do with the operation of your business, but it's just kind of, oh yeah, by the way, we made some money, and oh, by the way, we lost some money. Let's talk about the oh, by the ways. Other revenue. Interest revenue. So if you have invested somewhere and you're making money, that's a form of revenue. It's just that it doesn't have to do with the livelihood of your business. Dividend revenue. Let's say you've invested in some stocks and they're paying out dividends. That's another form of revenue, but it's not like I'm selling flowers at Sweet Lily's and that's my moneymaker. Well, maybe they've invested some money too and they get some little kickbacks from their stocks and investments. Rent revenue. The old Thrifty building has 2 apartments above it. Did you guys know that? Okay, so the old Thrifty building that used to be on the corner. Was that their livelihood? Renting out the apartments? No, their livelihood was being a place for prescriptions to be picked up and gifts. They just happened to own 2, I think it was 2 apartments above. So that's considered another form of revenue, kind of a little bonus, if you will. Their operations, their day-to-day operations had nothing to do with the apartments above that they happened to rent out. It's just that they had them, and that's another form of revenue. Gain from the sale of PPE. Okay, so I know now I'm popping between businesses here, but let's go back to Sweet Lily's. Sweet Lily's has their little delivery van, right? If they sell the delivery van, is that considered revenue up here? No. Revenue they make is when they sell flowers. If they sell their delivery van, that's money made on something else. So it still is money in the business. It's just that it doesn't get to be up with the big dogs up here with revenue. It's got to be the other revenue. Other expenses, and I'd be writing some of these down just because they're really handy to have. Other expenses, so other money out. Maybe we have a note or a loan and we're paying interest expense on it. Casual losses, like maybe someone breaks into your building and you have to replace $1,000 worth of windows. Is that a general operating expense? No, you just had a bad day and someone broke your window, and that's down here because it doesn't relate directly to the operations of the business. Do you think that casual loss happens though from time to time? Do you think your employees happen to steal some stuff from you? You hope not, okay? Or maybe you have a fire in the kitchen and you got to replace that. Well, that's not part of your operating expenses, it's other expenses. So let's say you go sell the delivery van, but you take a loss. That would be other expense instead of other revenue. If you didn't make any money on it, it would be a loss. And then they give one an example of loss from strikes by employees. So if your employees are on strike and you're not paying them or they're not coming to work, that's an other expense. What you need to know about operating expenses versus non-operating. Operating has to do with the livelihood of the business. Anything that doesn't really fit up here, making money or expending money, goes in the other column. What can I answer about that, or is it pretty straightforward? A single step income statement is like what we did before. It's either a revenue or an expense, and you land it, hopefully, in net income. You'll notice what we did in this multi-step is we talk about operations and non-operations. And we take a look at, before we even get to our expenses, we say, okay, did people return stuff? Did they pay us early? Those contra revenues. And then was there a cost of goods sold that offset all the revenue? So a single step doesn't stop. I am making my stop sign right. We don't stop after revenues and roll into expenses. We just keep going. And then these kind of things are built down here. You might say, why don't we do it this way? This seems so much easier than this mess. Well, you have a closer look at everything here. Last thing I want to talk to you about is what's called, well, you're finally getting introduced to some ratios. Are any of you doing the BPA contest accounting? Okay. You're going to want to know ratios, and we're going to keep going with ratios. You're not going to regions until the end of January. So ratios will likely be on some of your BPA contests. Ratios are simply a quick little math problem to analyze what's going on here. So I can present this to my manager, boss, decision maker, and they can pull numbers out of there and run what's called a ratio to see how successful we're being as a business, or productivity, if you will. So what you need to know for this chapter, and we'll get into more of them here in the coming chapters, the gross profit rate takes gross profit divided by net sales. That's what I'd get in your notes. Gross profit divided by net sales. You're basically taking the revenue section of your income statement. So you're taking COGS divided by the top part, or the contra revenues. What is it measuring? How many cents of each dollar actually goes into profit? So that's what I just got done showing you from our SCMC folks. Do you remember their dollar amount? I don't want to say it on the recording, but they take a look at all the money in minus all the money just to do business. Not even including, this has nothing to do with expenses. This has to do with sales returns and allowances. This has to do with the discount we give in COGS. So we take our gross profit divided by our net sales, and this is what I'd make sure is blaring in your notes. How many cents of each sales dollar goes into actually being pure profit? What you also need to know about this ratio, though, it's not the true picture. because not overall profitability, because of the operating expenses are not factored into this. This is just the top, upper top portion of the income statement. So it's only looking at revenue minus all the contra revenues, basically. It's not a true picture of the overall profitability simply because we haven't tackled the bottom part, or in other words, all the expenses. So gross profit divided by net sales. If I go back out here, gross profit divided by net sales. Someone have a calculator handy? Take 144,000 divided by 460,000. See a couple of you doing it. What'd you get? So 144,000, so gross profit divided by net sales. So that means for every dollar they're selling, their profit is 31 cents. Or for every $100 they're selling, their true profit is $31. You could keep on going up the scale. The question is that very good? Because we haven't even done this part yet. We haven't even chopped up, but they're saying, you know, and the factors here are COGS, sales discounts, sales returns, and allowances. So the question is, what would make that number go up? Don't let people return stuff. Are you going to have happy customers? No. What else would make that number go up? Don't offer sales discounts to your ARs. Don't give them a 2% off or 3% off if they pay early. Again, is that giving you very happy customers? So you see that fine line of, we need to bring our gross profit margin up, but we need customers who are happy and are coming back and saying good things about us. Fine line there. What could we do here to bring this number up? If we're Town and Country buying Under Armour sweatshirts and selling them, obviously Town and Country buys a lot more than that. What could we do to get that 31 cents on the dollar up pertaining to cost of goods sold? If we want to make more money, this is a big offset here. Carrie, shop around those wholesalers. Find cheaper sweatshirts to buy without compromising quality. Shop around, like Carrie said. Maybe buy in bulk if we can afford it, because buying in bulk typically reduces the cost of goods sold. I wanted to go back here. This is the classified balance sheet, or a multi-step income statement. Revenue, well, revenue minus the two contras equals, was it net sales? I think so. Minus cost of goods sold was gross profit. Right here, this is the top, especially with the stuff that I just added. This was the top of that multi-step income statement. We took gross profit divided by net sales to figure out, what was it called again, the ratio? The gross profit. Yep, gross profit ratio, right? Rate, ratio, yep, they're kind of the same thing. Okay, then we can subtract off our expenses. Now, we stop here though, and then we have the other revenue, the other expenses, to have a net income, hopefully. If you're sitting here scratching your head going, what? There were a lot of steps there, Mrs. Mars. Holy moly. We're going to do it tomorrow, and we're going to keep doing it on Friday. Okay? You're going to do many multi-step income statements. We're not even going to touch the single step. I want to do the multi-step. Okay? It's more complicated, but it breaks things down in a much more clear picture. Then we'll run that rate or ratio a couple times. Okay? And then what we'll do tomorrow is after you've like crunched the numbers and like done a couple income statements, we'll take comparative looks at things. Okay? The 31 cents on a dollar, that doesn't seem like very much. Okay, then what can we do to alter that? Like Carrie said, shop around for different wholesalers, buy cheaper stuff. Okay, so that's what we'll do in the coming days. Just like always, you're probably a little bit unsettled right now. Trust the process, trust me. Know that by the end of the week, you're going to be like, let's take a test. Let's do this. Next week, the cool part about in-class time, we'll do problem A together. You'll have time to do problem B. You'll have time to do the practice test right in class. Okay? And then the test will be next Friday. If you're confused, just trust me. Trust the process.